Last week, we had central bankers from around the world meet in Jackson Hole, Wyoming to talk about the state of the economy, to talk about inflation, and talk about what might be coming ahead when it comes to interest rates. And Jerome Powell, who was the chairman of the Federal Reserve Bank here in the United States, talked about what he thought is going on with inflation, the economy, and interest rates. And what he says is that inflation is still fighting an uphill battle. And right now, he is prepared to, quote, raise rates further. Now, the interesting thing is later this week, we're going to get the next inflation data results. We're going to get the next PCE data, the core inflation data on Thursday. And what is expected for the inflation data this Thursday is that inflation is expected to rise by 4.2% year over year, which is higher than where we were 1 month ago. So we're seeing still this expectation that inflation is still actually rising instead of actually slowing down. And this is where Jerome Powell is saying, well, we might have to keep raising interest rates further, so stay tuned on that. But then the topic got even more interesting when we heard what central bankers had to say regarding the economy. Because what Jerome Powell said regarding the economy is, quote, we are attentive to signs that the economy may not be cooling as expected. He said this on Friday. Now, essentially what he's saying is, well, just kind of piggybacking off of what he said in his last meeting, which is that he no longer believes that the United States is en route for an economic recession or an economic slowdown. Now, partially, this could be because, well, there's still a lot of money out there. But a big reason why we're not seeing an economic slowdown, according to Jerome Powell, is because people are still spending money. And over this weekend, Business Insider also put out an article titled, Consumers Aren't Even Close to Being Tapped Out. If you want to read this article, I'll link it for you down in the description. But I want to go over why Business Insiders is saying that consumers still have a lot of spending ability. And the reason why this is so important is because our economic system runs on spending. The more money you spend, the more money somebody else makes. So it's a cycle where if people can keep spending, even if it's going into debt to spend, that keeps the economy moving. But if people run out of the ability to spend because they have to go, well, into their savings and now they don't have any more savings, or they dig so far into their debt that they can no longer spend money on the credit card, that's when the spending slows down. And this is where Business Insiders is saying that consumers have a whole lot more ability to spend. And there's 5 things that Business Insider talks about. And by the way, the reason why we have this kind of weird background is because I am still traveling right now. Currently, I'm in California for a couple of days, then I'm gonna go back to the office and I'm heading over to New York for a little bit of work. But the 5 things that Business Insiders talks about is number 1, that Americans have low debt to income ratios. Number 2, is that Americans have way more assets than liabilities. Number 3, Americans have a whole lot of home equity that is untapped. Number 4, Americans have low mortgage rates that are locked in. And number 5, retail spending is solid and Americans have cash to spend. So let's dive into what Business Insider says, and then let me put this all together. So starting with the low debt to income ratios, we've heard now that credit card debt has broken a new record of $1 trillion. And what Business Insider said is, quote, while $1 trillion in credit card debt sounds like a lot, because it is, what really matters is whether consumers can pay down those debts. And they most definitely can. Now, let me start by addressing that, because they are 100% right. Too much debt is not a problem, but it becomes a problem when it is a problem. And when does it become a problem? When people lose the ability to spend. What Business Insider's focuses on is, okay, yeah, Americans have this debt right now, but they can make the monthly payments. No big deal. See, the problem isn't the amount of debt out there. It's when people lose the ability to make their monthly payments, then what? Because a lot of people always assume that people will always be able to make their monthly payments. They always assume that people will continue to have jobs, that incomes will always continue to grow. But our economic system has cycles. Asset classes have cycles. Our economy goes through booms and busts. Asset classes go through booms and busts. So eventually there will be a time when people lose their jobs. That's where recessions are. We've had a recession pretty much every decade for the last century. That's a fact. So if now, at some point in the future, who knows when, but at some point in the future, people start losing their jobs and they lose the ability to make the payments on their debt, that's when the $1 trillion worth of debt will become a problem. Now, back to the article. What they said is that less than 10% of a US income's household income, disposable income, is going towards debt payments, which includes mortgages, auto loans, and credit card liabilities. So, Business Insiders is saying that Americans are making so much money that less than 10% of a household's disposable income is being used to pay off any of their debt, which is less than where we were before the pandemic. And so because of that, hey, yeah, we have a whole bunch of credit card debt. Yeah, student loans are coming back. Yeah, people are racking up their card loans. No big deal, because the amount of money people have to pay relative to their disposable income is a lot lower than where we were before. That's what Business Insider says for part one. Part two is that consumer assets dwarf liabilities. And what they're saying is essentially that, yeah, we have a lot of debts in the economy right now, but because the valuation of assets like real estate, stocks, watches, I don't know whatever assets they want to classify, even though watch prices have fallen, but I'll ignore that. Asset prices are so high that even though people have seen a growth in liabilities, this growth in asset prices is making up for that. They said that the collective net worth of United States consumers is currently sitting just below $150 trillion, while debt is just below $20 trillion. Now, I don't know exactly where they got this data from. However, there's a couple things you want to understand on this. Asset values are fluid, and they fluctuate based off of partially the strength in the economy. So, if we were to see any sort of economic slowdown, then asset prices would drop. And if asset prices drop, well, now that assets dwarfing liabilities can meet or potentially flip, because then asset prices can drop very quickly. We remember in 2020 how fast stock prices fell. We remember in 2008 how fast real estate and stock prices fell. We remember in 2000 how fast stock prices fell. So asset prices can fall quickly, especially when people start to panic. This brings me to number three, which is Americans have a lot of home equity, which is untapped. Now, I've made a video talking about this before. Wells Fargo did a report essentially recommending that if you are a homeowner, you bought a home a few years ago, you have a lot of home equity, you can pull that cash out and then you can spend that cash and not have to worry about credit card debt and keep living a lifestyle even though you have to go into debt. Now, from a completely, let's call it logical perspective, that makes no sense. If you can't afford the Gucci, if you can't afford the vacations, don't spend that money. But we live in a consumerism culture where people want to spend. And right now, like I was saying before, asset prices are high. Real estate prices are high. And you have a lot of homeowners who have a lot of invisible equity in their homes, which means if you want to keep spending your money and the prices of things are more expensive than what you want to pay, you could just pull that cash out of your home. Maybe you got to pay 7 or 8%, but no big deal. And now you can keep living your life. So spending is still there. Remember, that spending, you pulling cash out of your home to go and spend it is not good for you, but it's good for the economy. And this is where consumers are still not tapped out because they can pull that cash out of their home. Number four, that a lot of Americans have locked in low mortgage rates. Because I forget the exact number, I think it's something like 80% of American homeowners today have a mortgage under 6%. Something around there, don't quote me on that, but it's something around there. Which means the vast majority of Americans have locked in a low mortgage rate, 2.5%, 3.5%, 4.5%, 5.5%. And so as long as you don't do a cash out refinance and then create a new mortgage, you're locked in at that price, which means it doesn't really matter what's going on. If you can afford the monthly payments, you're all good. And then the fifth thing that Business Insider talks about is that spending is strong and Americans have cash on hand. And here's what they said. All the hard data shows a consumer that can withstand a few hiccups, like a restart in monthly student loan payments. So the data says Americans are spending, and because Americans are spending so strongly, because Americans have the ability to go into credit card debt, because Americans have the ability to pull cash out of their homes, because Americans have the ability to go out and shop, we can withstand a few hiccups. No big deal if Americans have to pay another $400 or $500 a month on their student loans. No big deal if inflation is still a little higher than expected. No big deal if the economy is slowing a little bit. Americans can withstand it because we have seen them spend, and because of how strongly they can spend, they have the ability to keep the economy booming. So those are the 5 things that Business Insider says. So now let's tie it all together. We have the Federal Reserve Bank saying we are not seeing the economy slow as expected. We think interest rates might have to go even higher than expected. Higher interest rates slow down the economy. Higher interest rates take time to get absorbed into the economy. And inflation is still expected to go up. Remember, the expectation, the economist's expectation for inflation, which is going to come out this week, is higher than where we were a month ago. So we're still seeing inflation not just go straight down. We're seeing inflation either plateau or potentially start trickling upwards, because a month ago we also saw inflation trickle upwards. So if inflation is starting to go upwards, that means the Fed has to be more aggressive on inflation. If they have to be more aggressive on inflation, that means higher interest rates. Higher interest rates mean more cool down in the economy, and you can start to see how all these factors play together, which is why you want to be paying attention to what's happening. Of course, we're keeping you updated on Market Briefs. Market Briefs is my free financial newsletter. If you have not joined Market Briefs yet, what are you waiting for? It's a free way for you to stay up to date on what's happening in the top finance and business news. You got nothing to lose. If you don't love it, you can unsubscribe. You can go to briefs.co/market. That's briefs.co/market. And I also got the link for you down in the description below if you want to join. But this is where, again, it is so important for you to get financially educated and for you to get financially smart. And why I keep saying 2023 is not the year for you to go out and find us a new truck. This is the year to get financially smart, because we have all these red flags happening. And when most people don't assume anything bad will happen, that's generally when you start to see more economic pain, which is why you want to make sure you're preparing and understanding what's going on in the markets as well.